Hello, welcome to today's session. The topic of today's discussion is cost of capital. So, what is cost of capital? Cost of capital is a required rate of return. It is that rate of return which is required by an organization, by a company to earn, that it has to earn this rate of return in order to satisfy, in order to fulfill the cost of financing, the cost associated with purchasing those assets with the cost of investment. That is, it is that required rate of return, it is that rate which the firm is required to earn, okay, from its future projects, from its investments, to satisfy its investor. Satisfy its investor means it has to pay the investors dividend and interest in the return as a cost of financing those assets, because the company has taken the money of the investors and it has to pay them back in the form of dividend and interest. And if the company is paying them back on time and proper interest and higher dividend, only then the investors will get satisfied and meets their financial objectives. I will explain it through an example. Suppose these are the group of investors. These are investors. This is a company. These investors has invested their money in XYZ company. Now this company is thinking to invest in a proposal, that the proposed proposal is project A. This company is thinking to invest in project A. The company will invest, the sources of money are from investor. So the company will invest the investors money from this project. After investing, it will get some return after a time. From this return only the company will pay back the investors in the form of interest, or if they have taken loan or any debentures, then it has to pay interest or dividend in the case of shares. Okay, so the company has to pay them in the form of interest and dividend if they are using their money in the form of returns. These are the returns to investors. Okay, so this is that rate of return. This is the minimum criteria that the project it is proposing, that the project it is thinking to invest, it has selected to invest, must cover these cost of financing. This interest and dividend payment is known as the cost of financing the asset, the cost of financing the project. So this is the minimum criteria, minimum requirement, or one can say cost of capital is set as a benchmark. It is set as a benchmark limit that the proposed proposal must cover up this amount of cost of investing the asset. Only then we will invest, we will follow up that project only, otherwise we will reject that proposal. So cost of capital is the required rate of return. It is that rate of return, it is that required rate of return that the company must has to earn on its investments in order to satisfy the investors and meets its financial objective. So one can say that an investment to be worthwhile, there must be that expected return, the return on investment, expected return must be more than the cost. Return must be more than the cost associated with purchasing those assets or those investments. Okay, so this is the minimum criteria for an investment to be worthwhile. Only then the investment will be profitable, will be worthwhile, it is worthy to invest, otherwise we will not invest in that project. So a firm can achieve its object. The objective of firm is to maximize the value of shareholders. To maximize the shareholders' wealth can be achieved only and only if the earnings of the company are more than the cost of capital. If the earning of the company are more than the cost of capital, only then the objective of the shareholders to create the value for shareholders can be achieved. So it is that minimum, it is act as a financial metric, as it helps in determine the minimum rate of return which is necessary. It is that return which is necessary to create value for shareholders. Okay, so it set as a minimum requirement in investing a project. So first of all, what thing which we have to see while taking the investment decision whether to invest in this or not is the cost of capital. If we are covering the cost of capital, if we are covering the cost of investors, cost of financing the assets, only then we will invest in that project. If the returns are less then the cost we have incurred in purchasing that asset, then we will reject that proposal. Okay, so cost of capital is different from investor point of view and different from company point of view. From if we talk about investor point of view, it is sacrifice made by him with regard to capital formation, the savings that he has invested in the business in by purchasing the shares or any other thing. He has foregone his next best opportunity, or one can say the opportunity cost. So the return must be such that it covers its opportunity cost. Okay, so next one is, if we see about from the firm point of view, from company point of view, the cost of capital is nothing but minimum required rate of return. Okay, next is importance of cost of capital. How the cost of capital, how to see the cost of capital is important for a company. If we, first importance is capital budgeting decisions. Capital budgeting decisions are long term decisions. Long term decision, capital budgeting decision is a process which helps in taking the long term decision whether to invest in this project or not. If there are various proposal like A, B, C, D, various project, so which project to invest in, feasible or not, is studied under capital budgeting decisions. It helps the organization for different alternatives in respect of major fixed assets, that is it helps in taking the investment decision. So there is a method, one method of capital budgeting decision is NPV method. Under NPV method, what we see the future returns. Future returns, the returns that we earn in the future, we do its present value. We consider the present value of future returns and compare it with the cost of investment. Cost of investment. If the present value of future returns are more than the cost we have initiated or cost of investment, only then we will accept the proposal, otherwise we will reject the proposal. But how we will calculate the present value of future earnings? We will calculate it according to the cost of capital. We will consider cost of capital as the discounting factor. This is the discounting rate at which we discount, we do the future earnings, we discount the future returns and calculate its present value. So cost of capital is very much important in taking capital budgeting decisions. Next one is capital structure decision. So what is capital structure decision? Capital structure decision means designing, it helps in designing the capital structure of a company. Capital structure means how much proportion of debt and equity should be there. Debt and equity should be there. An optimum capital structure is that capital structure in which debt, there is both debt and equity, that is the benefit of both the sources of finance we will get. An optimum capital structure says that the debt should be 2:1. The capital structure must be 2:1, that is debt must be twice the holding of equity. Okay, so the trade-off theory of capital structure tells us that managers should seek optimum mix. There is an optimum mix of both debt as well as equity, which helps in reducing the weighted average cost of capital. That is, the overall cost of capital can be reduced with the inclusion of debt in the equity. The optimum capital structure represent the trade of that, as debt is the cheapest source of finance. The cost on debt is less, whereas the cost on equity is more. Less equities are more costlier than debt. So inclusion of both debt and equity in a capital structure is refers to as a trade-off theory, which says that if we include debt in the capital structure, it will helps in the return. It will give more return rather than only inclusion of equity. This inclusion of debt is also called as leverage, as we are leveraged our earnings with the inclusion of debt in our capital structure. So this is all about capital structure. So cost of capital, the main aim of making the capital structure, of designing the capital structure, is to reducing the cost of capital. The optimum capital structure will be that in which the cost of capital will be minimum. So it also has